Frankly, for silver to now be well beyond its previous all-time 45-year high of $50, and one of the things that I think for me suggests strongly that yes, there is absolutely physical tightness. It is the fact that we've heard even from some of the more, let's say, mainstream or conservative outlets that report on these things. That in London, physical tightness was very, very, there was very high physical tightness in London, where most of the ETF silver is held. And so it was becoming impossible for them to make deliveries, which doesn't look good for a futures exchange. And so we also saw from research that inventories in China had reached 10-year lows. And I believe those are perhaps all-time lows for them because their exchange hasn't been around all that long. So it's assumed that likely significant inventories were shifted from Shanghai to London. And I compare this to what we call a shell game. So you have shells and you have, let's say, a ball under, you have 3 shells and you have a ball under one of them, and you move the shells around and you have to guess where's the ball. Well, in this case, it's where is the silver? And moving it, no matter how much you move the shells around, there's still one ball. And no matter how much you move the silver around, it doesn't mean you have more silver. You just change the location.
According to Peter Krauth, silver's rally is driven by real physical shortages as inventories in London and China hit multi-year lows, with metal simply being moved around in a shell game. Ongoing structural deficits since 2021 and inelastic mine supply support higher prices, even if a short-term correction occurs near $70. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
I would say possibly, yes. I would not deny that possibility at all. In fact, even through this summer and through the fall, as it was going through $35, $40, $45, and $50 ultimately in October, I personally felt like it was advancing too quickly. But the market, was right, because we're at 70 now and that was 45. So I'm assuming, that was right. But I think that it signified a lot of pent-up demand that was on the sidelines, cash, people who were watching, waiting, and each time you had a small pullback, it was being bought. It was being bought. Same for gold. Small pullbacks just attracted more money, and it was never really sort of allowed to fall very much. Then we got a correction in October, a little bit after it reached, I think it was 54 or 55. It was a meaningful correction, dropped to, I believe it was high 40s, and that's the lowest we've seen so far. I think it's a combination of all of these things have kind of come together at the same time, and because this is a massive move, even for silver, which can do this, as we know from history, but it is massive, and this year alone, as you said, about 140% return. This is, I think, I want to caution people, not something you should expect every year. And in fact, if we got that every year, the bull would be over probably quite quickly. And we don't want that either. But as you said, I think it's definitely a clear sign of physical tightness. We saw this start. In fact, well, you and I have talked about this before, but I started signaling this issue back in early 2024, saying that for me, the main reason that the silver price was really seemed capped at maybe $28, $30 was because there were these large secondary inventories, produced silver just sitting above ground in bar form at the major futures exchanges like Shanghai, LBMA, COMEX. And the big consumers were able to go and, buy a long contract, futures contract, and stand for delivery, take delivery of that silver when their contract matured. And because this silver was already produced, already sitting above ground, sitting in inventory, this did not put pressure on the silver price because miners didn't have to try to bring more to market. You didn't have to try to draw more silver out of maybe private holdings of silver through a higher price. But I said that, based on the decline that we saw, significant decline from early 2021 up until, let's say, late 23, early 24 in these inventories, that if at this pace, it could only continue maybe 12 to 18 months. It's funny because when I started my newsletter, it was actually January of 2021. And I remember very well that silver squeeze, which was right at the end of that January. And I told my subscribers, I said, this is not something that's fundamental. There's plenty of silver available. And it's purely sentiment because you had these meme stocks that were going crazy, GameStop and so on. And somebody, I think it was on Reddit, suggested that people should buy silver to squeeze out silver shorts. And so that's basically what took place. It was a phenomenal occurrence. It lasted a matter of a few weeks. And I said, let's not expect this to last because there's no basis really for it. It pretty much played out that way. I think it's not the case this time. We do have shortages. We had surpluses on balance from, I believe, about, say 20, from what we see in Silver Institute reports, for 5 to 10 years prior to 2020, 2021, we had surpluses. So we were consuming less silver than we were producing. And these surpluses would end up in the futures exchanges, in their inventories. Ever since 2021, we are in structural deficits. And this year will be the fourth consecutive year. The World Silver Survey that's put out by the Silver Institute forecasts that the next 5 years we will not only see ongoing structural deficits, but we will see new record high deficits. Simply because, even if demand were to stay where it is, or even frankly drop a little bit, the production is not meeting demand by any stretch of the imagination. We had maximum production of silver back in 2016, so 10 years ago was the last time silver mine production peaked. It was 900 million ounces. We have not been able to, we've averaged over the last 5 years, we've averaged about 830 million ounces. So we're not even close. And the forecast is mine supply will stay flat, maybe up 1% or so if you're lucky, in a year or two. But demand is not expected to drop significantly, and it's to the tune of 10 to 15% above supply. And so that's why they expect these deficits to continue for several years. And we can go into all kinds of reasons why, these deficits are likely to continue. So mining silver is very particular and really actually different in many ways from other metals. And that just makes it what I call supply inelastic to price. It's very difficult to mine silver. Only 25% of mined silver comes from primary silver mines. 75% of mined silver comes as a byproduct of mining gold, copper, lead, and zinc. So these producers of other metals, including silver, have little to no interest in trying to produce more silver if the price of silver goes up, because the amount of silver they produce and its meaning to their revenue stream is so small, they just are happy to accept a higher silver price for what they already produce. And frankly, Lucien, you can get it even more exacerbated by some miners will say, well, the silver price is now $60 or $70. I have the flexibility with my mine to go and produce silver from a lower grade area in my deposit. So because the silver price is so much higher, I can now actually produce less silver output every year and make the same profit because the silver price is so high. So a higher price may mean even less silver coming to market in some case, and of course, therefore, push the price even higher. Uncertainty around tariffs, where especially in the US, traders and so on were worried that if they had to deliver silver to contract holders, that if that silver had to come from offshore, that it may be taxed because of tariffs. So that would cost them. So they wanted to get the silver into the US before potential tariffs. So, that moving the silver around doesn't change the tightness, but it does reflect, I guess, the need to be nimble and to react. And we were seeing big deliveries from those exchanges. So this was going into sort of privately held warehouses. It was not shifting all from one exchange to the other. And then, after at that point, so let's say a year ago, we were already into the third year of massive central bank buying of gold, to the tune of nearly 1 out of every 3 ounces of gold that came from mining each year for the last 3 years went to central banks. So they know something. You can't. I often say, do as they do, not as they say. And so they've been buying a lot of gold. And we know also from history, and I talk about this in the book, that silver outperforms gold over the longer term, but in the shorter term, it underperforms. And then eventually it catches up and then it surpasses. And I think that, people who have been following gold and see it at $4,000, $4,500 now almost, and staying at these sustained high prices are saying to themselves, wow, maybe I need exposure to gold, but $4,500 US for one little coin is a lot of money. So what are my alternatives? And silver has always been that natural alternative. So it's an inflation hedge the way gold is, and it's, affected by these other things that I mentioned before. So as I say, all of this has come together and produced quite the bull market in silver. Yes, in fact, I was just reading yesterday some research that suggests that there's different things you can look at. One of them is the silver futures in the U.S. and there's what we call smart money and speculators, with not say dumb money, but speculators. And the speculators are very long silver. And this is typically a sign that it has gotten somewhat overheated. So yes, I would say yes, there is, especially now at $70. This is also, psychologically, it's a milestone level. $70 is, all the round numbers are kind of a big deal. The round and the fives, 70, 65, 70, they're all kind of big deals. And but 70 is a big number, and especially given where it has been over the last couple of years, and then again, a new all-time high record. I would say yes. There's significant chance that we would get a correction. It could could take any form. It could be quick and small. It could be quick and deep. It could be more drawn out. You could get a drop and then it moves sideways, or it could even peak at 70 and move sideways, and it could consolidate. People need to realize that you can get price corrections over time, not only in the number. So I'm not saying this will happen, but we've seen these kinds of things happen before. Let's say now, potentially silver could, let's say, stay in a range close to around 70 and maybe stay there for 2 months, 3 months. It's not impossible. We have seen these things happen before. There is, the beginnings of interest. I don't think we're anywhere near euphoria. Euphoria happens when you're out at a cocktail party and someone starts asking you which silver stocks you own, especially exploration stocks. Yeah. And I can tell you, nobody is talking to me about silver stocks at any parties. So I think we're probably a long way from that. Most people have no idea even what the silver price is right now. So, it is starting. I do hear the beginnings of it, but I believe we are a long way off from that state. So I don't see production helping to alleviate deficits. What I do see is there's more M&A. I believe that you see these larger producers have the benefit now of a higher share price, which they can use as a currency, and they go out and use their shares to buy smaller companies who either have an economic deposit, maybe already producers themselves, or you have so those are acquisitions. You have mergers. We've heard a lot more mergers, and I have been hearing a lot more from these smaller silver mining CEOs that their intention is actually to, although they're on the exploration side and they have a significant market cap, they have enough access to capital that there are several examples. In fact, I'm not going to name names, but these companies have a intention, or at least are looking to acquire producing assets. They want to move towards being in a position where they can produce cash flow. The cash flow helps them to continue exploration without, diluting shareholders and having to keep raising money. And it's the right kind of environment for it. I mean, there's been huge amounts of capital raises just in the last 4 or 5 months. It's been massive. So right now the ratio is at about 64 and maybe even 63 with today's move, but somewhere around 64. I do think that we will see silver higher, but I also think that we will see gold higher. So I'm not sure we will see a very big move. I think the move will be down, meaning silver will continue to gain against gold. But if we're at 64 now, honestly, I would say 55, maybe on the low side 50. But that could signal considerably higher silver from today's price, depending, of course, on what gold does.